Hello, welcome everybody to today's 1031 Exchange Basics webinar. My name is Jeff Stechmann, the Business Development Manager for Asset Exchange Company. Before we kind of get started, just want to kind of give you all some information how we're going to handle today's webinar. Don't feel like you have to write every single thing down. You will receive a link to today's recording if you want to listen to it at a future date. And then also a lot of the information I'm going to talk to you guys about today, I have in just various PDF, single topic PDFs that I can send out to you, email them out to you. And if you'd like to have those PDFs sent over to you, please just let me know. My contact information's up on the screen, and I'll email them over to you. And I'll mention it again at the very end of the presentation. I'll show you my contact information again. And then also, as far as how we're going to handle questions today, I'll open the floor up to questions at the very end of the presentation, because I find a lot of cases, if you do have a question, a lot of times it's going to be answered in an upcoming slide, but if for some reason it isn't, then again, at the end, we'll open the floor up to questions. There's a box on your right-hand side that says questions. Right there is where you want to type it in. So let's go ahead and dive right in. So again, a few people joined a little bit late. Again, my name is Jeff Stechmann, Business Development Manager. And kind of give you all some information about myself. I've actually been in the business for 25 years. I got my start in the business on the title side of the business, the closing side. I'm originally from New Orleans, so if you hear the accent come through, please forgive me. Every now and then it rears its ugly head. But I'm actually located now in Tampa, Florida. I've been located in Florida for 22 out of those 25 years. So as long as I've been in the industry, I've seen the really good times in the real estate industry. And, boy, I've seen the really bad times too. And, hopefully we never have to see those bad times again. Things slowed up a little earlier, a few months ago with the COVID-19 shutdown. But I tell you right now, things are really busy. Most people that I talk to in the real estate industry talk about how busy they are. So that's really an encouraging sign. Now, let me give you all some information about the company. So again, we're Asset Exchange Company. We've actually been in business since 2006. And over the course of our existence, we've done about 35,000 1031 exchanges. It's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the business, we're known as a qualified intermediary, so QI for short. Now, some other terms you may hear people refer to is an accommodator. Another common term is a facilitator, or just simply an intermediary. But most people call us QIs. And, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. We hold the proceeds from that sale on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange. So that's our main job in a 1031. Now, as far as a government agency or a governing body that oversees what we do, well, at least on a federal level, there actually is no federal agency that oversees what we do. So what does that mean? Well, what that means is anybody out there can be a QI. There's no type of requirement you have to have any type of E&O insurance. There's no type of requirement you have to have any type of bond. There's no guidelines on where you hold the proceeds, the type of funds you hold the proceeds in. It's a really scary, scary thought when you think about it. So if anybody on the line today is currently involved with the 1031 exchange, please just make sure you do your due diligence and you're dealing with a reputable company. Great news when you deal with us is we're actually based out of California. Our home office is in San Francisco, and because we're based out of California, well, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have, the bond that we have. We're subject to audit by that Franchise Tax Board. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in. That's all overseen by that franchise tax board, which is great for anybody that deals with us in California, but anything that we do nationwide, because, we do 1031 exchanges all over the country. Well, that franchise tax board has oversight in anything that we do because, as I mentioned, they can come into our office at a moment's notice and audit any of the files that we work on, not just California property, but anything that we do. So you do have some assurances when you deal with us. And then also, as far as our ownership goes, we're actually owned by two gentlemen, and they've been in the 1031 exchange business for 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is actually considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The reason I like to bring his name up is because one of the things that we offer that I don't know if any other QI in the business offers is any of the exchanges that we're involved with, if for some reason they were to get audited by the IRS, we actually would provide free audit support. Again, there's no additional fees for that. We'd work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney, Adam Skarsgård. So another great reason to deal with us. Now, let's talk a little bit about the history of exchanging. So, believe it or not, exchanging has actually been around for close to 100 years, actually 99 years. Really started back in the 20s with farmers, and the way it worked back then, it was pretty simple. Maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat, and I wanted his farm and he wanted my farm. So all we did is just swap farms, and it was really that simple back in those days. But our modern day exchanges, kind of the format that we follow today, well, that was actually started back in 1979, and there was a gentleman by the name of T.J. Starker. He lived in California. And he owned all this land in California with timber on it. And what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is, in exchange for the land, they gave him what was referred to as exchange credits. And what Mr. Starker did with those exchange credits is, over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started by T.J. Starker back in 1979 in California. So if anybody in the line has ever heard the term a Starker exchange, well, that's where it comes from. It comes from T.J. Starker's last name. Now let's talk a little bit about the code. So, when we talk about 1031 tax deferred exchange, well, that name is actually derived from Internal Revenue Code Section 1031. All right, and the code states this: no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. All right, I know that's kind of a mouthful, right? Well, where the code states that property held for productive use in a trade or business, so you can do a 1031 exchange on any type of real property that you use for your trade or business. Now, I'll give you guys an example. Last year, we did an exchange for a gentleman. He owned a daycare center, so he was using that real property for his business, right? So he did an exchange with us, deferred his taxes, and we're going to talk about that in the next few minutes. And the replacement property he went out and purchased was another daycare center, because why? Well, he was going to use that for his business as well. So again, any type of real property that you use in your trade or business qualifies for 1031 exchange. All right. Now, the next part of the code where it states for investment. So for investment could be something as, let's say you own a single-family residential home and you hold that for investment. Well, how do you hold it for investment? Well, it's a rental property, right? So you could take that rental property, you could sell that rental property in a 1031 exchange, defer your taxes, and then what can you buy as a replacement? Well, that's the next part of the code, like-kind property. So what exactly is like-kind property? So like-kind property is any type of real property that you use in your trade or business or that you hold for investment, okay? And you can sell that in a 1031 exchange, and you can replace it, or you can purchase any other type of like-kind property, which is any type of real property that you use in your trade or business or that you hold for investment, all right? So Just because you own that single-family residential home for investment, that rental property, when you sell that in a 1031 exchange, you don't have to replace it with another single-family residential home. Now, you can if you want to, but you could even replace it with a duplex or fourplex. You could replace it with vacant land. You could even replace it with, let's say, a commercial strip shopping center, a commercial warehouse, a commercial downtown office building, one of the high rises in any metropolitan city in the United States. All right. So any type of real property, as long as what? As long as what you're selling, you're holding it in, you're using it in your trade or business, or you're holding it for investment. As long as what you're replacing it with, you're also going to use that in your trade or business, or you're going to hold it for investment. All right. And those properties can be located anywhere in the United States, including Guam or the U.S. Virgin Islands. All right. Now, Puerto Rico property in Puerto Rico is actually excluded from 1031 exchange. I think they're under a different tax structure than we are here in the States, and that's why property in Puerto Rico is excluded from 1031 exchange. All right. If anybody on the line has ever heard of the term a like-kind exchange, well, hey, that's where it comes from. It comes from that part of the code where it talks about like-kind property. All right. Now, what are current tax rates? So when you sell real property, if you have any gain in the property, you're going to be subject to capital gains taxes. Now, capital gains taxes right now are either 15% or 20%. Now, the 15% historically was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year. That's where you were at the 15% capital gains tax rate. Now, the 20% historically was applied if you had income single and income of greater than $400,000, or married income of greater than $450,000. That's where you were at the 20%. Now, I think the income levels have changed recently. They might be a little bit higher. The thresholds might be a little bit higher, but either way, you're still looking at either 15 or 20% capital gains tax rate. Now, on top of that, you also are going to be subject to what they refer to as depreciation recapture tax. Now, that's an additional 25% tax. Now, and everybody's asking, well, what is that? What is that exactly, right? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed in the property, the entire depreciation for the entire time, the total depreciation for the entire time that you've owned the property, when you go to sell that property, they're going to hit you with a 25% tax on the entire amount of depreciation you claimed in the property for the lifetime that you owned it. So you're going to be subject to depreciation recapture tax. On top of that, you may also be subject to what they refer to as the Medicare tax. Now, that's an additional 3.8% tax. Now, what exactly is that, right? Well, the Medicare tax, that was passed back in 2010 with the Affordable Care Act, Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the cost of the Affordable Care Act, right? So when you do a 1031 exchange, you can actually defer having to pay any of these taxes. All right. Now, what am I not listing up there? Well, I'm not listing anything to do with state income taxes. Right now, I'm located in Florida. We don't have state income taxes, so we don't need to worry about that. But if I live in a state, or even if I'm selling property in a state that has state income taxes, I would also be subject to any state income taxes. Now, when you do a 1031 exchange, you can also avoid having to pay the state income taxes. Now, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay the state income taxes. But the good news is it can be done. All right. So federal capital gains taxes, depreciation recapture tax, Medicare tax, and also any state income taxes that could potentially be due. When you do a 1031 exchange, you can avoid having to pay any of those taxes. Okay. Now, I get this question all the time. How long do I need to hold a property for it to be considered an investment property? And, the honest answer is I don't know, because there's nowhere in the code that actually states how long you need to own a property for it to be considered investment. It just states you need to use it in your trade or business, or you need to hold it for investment. Now, if you ask some CPAs, they'll tell you, well, a good rule of thumb is to really hold on to a property for a year, for 12 months. And if you think about the logic behind that for a minute, if I buy an investment property today, right, now I'm going to hold on to it for a year, for 12 months. So I'm actually going to claim that as an investment property in my 2020 taxes, right? Now I'm holding it for a year, remember. I'm also going to claim it as an investment property in my 2021 taxes. So I'm going to be reporting that property as an investment for 2 tax filing years. Anything associated with that property, any income that's coming in, any expenses, it's going to be reported over 2 tax filing years. Well, is that a good holding period? Well, the answer is maybe. All right. Now, some other CPAs will say, well, really a good holding period is really 2 years, for 24 months. Now, one of the reasons behind that, we're going to talk about it in the very next slide. But back in 2008, the IRS came out with guidelines regarding vacation homes, right? And in those guidelines, they stated that for a vacation home to be considered an investment property, you must own it for a minimum of 24 months, for 2 years. Now, some CPAs pick up on that and they say, well, for a vacation home, the IRS is giving us guidelines where you have to hold it a minimum of 2 years or 24 months for it to be considered an investment property. Therefore, any type of investment property, good rule of thumb is to hold on to it for at least 2 years or 24 months. But the reality of it is, it's not so much about how long you own the property; it's more so about your intent. And your intent could be something like this. Did you advertise the property for rent? Did you advertise it for fair market value rent? If fair market value rent is $1,500 a month and you're advertising it for $5,000 a month, you know what? The IRS may have an issue with that, right? If you get audited and the IRS comes in and says, hey, prove to us you held that property for investment, well, you know what? You're going to have to be able to back it up. All right. Now, I list one particular court case on the slide. It's referred to as Resnick versus the commissioner. Now, in that particular court case, the circumstances was you had a husband and wife. All right. They owned a single-family residential home. All right. Now, they also owned another and that was their primary home. They also owned another single-family residential home that was an investment property, a rental property, right? So what they did was they sold the rental property in a 1031 exchange. All right. Now, the replacement property they bought was another single-family residential home. That was going to be the new investment property, the new rental property. Now, 6 months after they did their 1031 exchange, during that 6-month period, they ran a classified ad in the town newspaper that they lived in, advertising the property for rent at fair market value. They even showed it to 2 potential renters during that 6-month period, but for whatever reason, they could never get the thing rented out. So after 8 months, what they did was they wound up selling their primary and they moved into the investment property. All right. In that particular court case, it was ruled that their intent was to hold that property as an investment. But what happened? Their circumstances changed, because what happened during that 6-month period, one of them lost their job. All right. And they had a mortgage on their primary. They had a mortgage on their investment property. They had to do something. So they decided after 8 months of ownership, they moved into the investment property. All right. So again, it's not so much about how long you own the property. It's more so about your intent. And again, if you get audited and the IRS comes in and says, hey, prove to us that you held that property for investment, you're going to have to be able to back it up. All right. Now, vacation homes. I always like to talk about vacation homes, especially living here in Florida, because, there's so many people that want a vacation home, or so many people that have a vacation home. All right. So how does that vacation home qualify as an investment property? So this is actually referred to as Revenue Procedure 2008-16. All right. Now, the first requirement I've already mentioned to you guys, you must own that property for a minimum of 24 months, 2 years. All right. Now, for every 12-month period of ownership, you must rent the property out at fair market value, all right, for a minimum of 14 days. All right. Now, you can use it for some personal use. All right. So for every 12-month period of ownership, you can actually use it for 14 days personal use, or 10% of the total time that it was rented. So what does that mean exactly? Let's just say during that 12-month period, you actually rented the property out for, let's say, 200 days. All right. So 10% of 200 would actually be what? would be 20, right? So you could use it for 20 days personal use instead of the 14. Right? If that property meets those guidelines, it qualifies as an investment property and you can sell it in a 1031 exchange. Now, if it doesn't meet those guidelines, I wouldn't necessarily say it would be disqualified. In that case, I would recommend to the client, I'd say, look, talk to your CPA. And if you and your CPA can come to an agreement where you feel like you can justify that property as being an investment property, then hey, by all means, use it and sell it in a 1031 exchange, right? We're always going to recommend to people, talk to your CPA. Because why? Because your CPA is going to have way more information about your tax situation than I ever would, right? Than I would even ever want to know, right? If the CPA comes back and says, yeah, I think we can justify it as being an investment property, then you know what? We move forward and you can use it in a 1031 exchange, right? Now, let's talk about the 1031 exchange guidelines, all right? We're going to cover some of the basic requirements, the property qualifications, the tax deferral requirements. There's some timelines everybody needs to be aware of, and there's also some identification rules, all right? So let's recap. What type of property can you do a 1031 exchange on? Any type of real property that you use in your trade or business or you hold for investment. And what can you exchange it for? What can you purchase as your replacement property? Any kind of like kind property, which is what? Again, any type of real property that you use in your trade or business or that you hold for investment, all right? And those properties can be located where? Anywhere in the United States, including Guam or the U.S. Virgin Islands, all right? Again, Puerto Rico, property in Puerto Rico is excluded from 1031 exchange, all right? Now, what other type of property is excluded from 1031 exchange? Well, your primary home, your primary residence, okay? You can't do a 1031 exchange on your primary. It has to be what? Investment to investment, property using your trade or business, or to investment or trade or business, okay? For your primary, you may qualify for what they refer to as a 121, a section 121. And basically the way the 121 works is you had to have lived in it as your primary for at least 2 years, all right? When you go to sell it, if you're single and you have gain, all right, the first $250,000 of any gain is tax exempt. And if you're married, the first $500,000 of any gain is tax exempt. That's referred to as a section 121. All right, you don't need anybody like me to help you with that. That's just something you file on your tax return on the year that you sell your primary home. All right, so your primary residence. All right, so again, you can't do a 1031 exchange either selling your primary or even purchasing your primary. All right, now what are the properties excluded from 1031? Property held for sale is excluded. Now, I'll give you guys an example for that. Let's say I'm a builder, all right? Now, in the state of Florida, we have a lot of these like national home builders like Pulte Homes, KB Homes, Lennar Homes, right? Let's just say I'm Pulte Homes. Now, Pulte, they're one of the largest single-family residential home builders in the entire country, right? They build properties in multiple states, new construction. Now, the properties that they build, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and they're not holding them for investment, well, they can't do 1031 exchanges on those types of properties. Because why? Because it's property held for sale. All right. Now, what other properties excluded from 1031? Well, dealer property is excluded. Now, dealer property might be somebody that we refer to as a flipper. You know, let's say they buy a property, a fixer-upper kind of thing. It takes them, maybe 2-3 months to fix it up. And then what do they do with it? Well, they turn around and sell it as well, right? So they can't do 1031 exchanges on those types of properties because that's like their inventory. You know, that's the business that they're in. They fix up properties, and what do? They turn around and sell them. All right. Now, you can't do 1031 exchanges on those types of properties. Now, here's an example. What if I'm a flipper, and let's say I buy a property, you know, again, 2 to 3 months it goes by and I fix it up. And instead of selling the property, they go to their realtor and they say, hey, can you put this in the MLS system for rent? Let's make sure we put it in there for fair market value rent. That's a little different. Why? Because now all of a sudden they're showing their intent that they're holding it for investment and they're not holding it for sale, right? Hey, who knows? Maybe they even show it to a potential renter. They run some type of credit report on the potential renter, and they decide, hey, they're not even going to rent it to that potential renter, right? If that flipper gets audited and the IRS comes in and says, hey, prove to us you held that property for investment and not for sale, they're going to have to be able to back it up. All right. Now, and they possibly could, the example I gave you, if that's what they do, because they could say, look, here's an email that I sent to my realtor asking them to put it into the MLS system at fair market value rent. Hey, here's the day it went into MLS showing it for rent. Here's the MLS listing showing it for rent, fair market value. Here's the day I showed it to that potential renter. Here's the day I ran that credit report. All of that type of stuff is going to be their backup, right? It's going to be their ammunition, their trail of breadcrumbs, right, to prove that they held the property for investment and not for sale, all right? But if they just strictly fix it up and then turn around and sell it, well, you can't do a 1031 exchange on it, all right? Now, foreign property is also excluded from 1031 exchange. Now, this might be pretty obvious, but let's say, I couldn't sell a property here in Florida and try to buy some replacement property in Canada or Mexico or somewhere in Europe. Okay, it has to be what? It has to be domestically located property, or including Guam or the U.S. Virgin Islands. All right, so foreign property is excluded from 1031 exchange. All right. Now let's talk about guideline number 2, the tax deferral requirement. So in order to get a full deferral, to defer your taxes 100%, okay, now rule number 1 is you must reinvest all of the net proceeds in property of equal or greater value. What exactly does that mean? What are the net proceeds? Well, the net proceeds, that's the cash, all right? That's the cash that normally you would get out of the closing. Now, we're the qualified intermediary, the QI, all right? We're going to hold those proceeds on behalf of the seller, the exchanger, because why? Because the rule is they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange, all right? So they can't close today and then call me tomorrow and say, hey, Jeff, I want to do that 1031 exchange. At that point, it's too late, all right? They can even close today and get in the parking lot and call me from the parking lot after the closing and say, hey, Jeff, I want to do a 1031 exchange. Because at that point, it may be, the fund may even be sitting in that escrow account of the title company or attorney or the escrow company, right? They might be waiting to wire the funds out to them. They would have at that point would be considered what they refer to as constructive receipt, right? They have a legal right to the funds. They lose their ability to do a 1031 exchange. So we have to get involved prior to the closing, prior to them signing the documents, okay? We have to get involved. And so we're going to hold the proceeds, all right? Now, what's the rest of the rule? Well, they have to take that entire amount, okay? And they're going to have to go out and they're going to have to buy a replacement property where the purchase price, all right, or purchase prices if they buy multiple properties are equal to or greater than whatever the sales price was on the property that they sold, all right? So they're not limited to even buying one replacement property. They could buy 2 replacement properties, 3 complete replacement properties, as long as the combined purchase prices are equal to or greater than whatever the sales price was on the property they sold, all right? Now, rule number 2 is you must acquire an equal amount or greater debt. Now, what exactly does that mean? Well, what that means is if you have a loan that you're paying off, all right, you have to get a loan of at least that amount or greater in any replacement property or properties. Now, that rule can actually have an exception, all right? Now, if you have cash that you can add to the purchase of the replacement property, you can offset having to acquire any debt or any additional debt, right? Now, obviously, if you have no loan, if you don't have a debt that you're paying off, there's no loan that you're paying off, well, you're not required to get a loan when you buy the replacement property, but you do have the option, all right? If you need to or if you want to, you can always get a loan to help you buy that replacement property. Okay, so that's the requirements. Now let's talk about guideline number 3, timelines. So there's some timelines everybody needs to be aware of. All right, so from when you sell your relinquished property, all right, you're going to have 180 calendar days to purchase any replacement property or properties, all right? And that's calendar days, that's holidays, that's weekends, okay? I'm located in Florida. Anybody that has anything on the eastern United States, the coastal areas, the Gulf Coast. Okay, we're in hurricane season right now. All right, from June 1st to the end of November is hurricane season. If any of those locations are getting hit by a hurricane and everything's shutting down for a day or two or a week, whatever it may be, it does not matter. The clock is still going to be ticking. All right, so it's 180 calendar days to purchase any replacement property or properties. Okay, now the first 45 days of the 180 is what's referred to as the identification period. Now, what does that mean? Well, the identification period is you must identify any potential property or properties that you want to buy. All right, now that's something else we're going to assist with. All right, we're going to provide a form to the client, the exchanger. It's called the identification ID letter. All right, and on that form, there's going to be blank lines. All right, and it's going to have to be specific to a property address or addresses. All right, they're going to have to fill it in, sign off on it, and get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property. They do it to us, the qualified intermediary. All right. Now, none of those properties even have to be under contract. You just have to put down any potential properties that you want to buy. But here's the thing. All right. Let's say you find that perfect property on day 46. All right. At that point, it's too late. All right. So whatever you put on that form by midnight of the 45th day, you're going to have to make sure you're going to be able to buy one of those properties. There is no exceptions after midnight of the 45th day. If for some reason you cannot purchase any of those properties, okay, that you put on the list by midnight of the 45th day, unfortunately, you're going to be paying all your taxes. All right. If you're closing on any of those properties, let's say it's day 181, you're going to be paying all your taxes. All right. So again, it's very specific to a total of 180 days to close, and the first 45 days of the 180, you have to identify any potential property or properties that you want to buy. All right. Now, guideline number 4, there's actually some rules to identifying. All right. Now, there's 3 different rules. All right, I'm going to read each one of the rules to you. And if you don't quite understand them when I read them to you, don't worry about it, all right? Because I'm going to show you how the numbers work. I'm going to give you examples of all 3 of the rules. And hopefully once I go over the examples, it'll click for you if you don't understand it quite when I read it to you, all right? So the most popular rule that we see, probably 90 to 95% of all the exchanges that we do fall under this first rule, all right? It's referred to as the 3-property rule. And that rule states this, 3-property rule states this: you can identify up to 3 properties without regard to the fair market value of those 3 properties, right? So what exactly does that mean, right? Well, if you identify 3 properties or less, okay, the purchase prices of any of those properties, they can be any dollar amount. It doesn't matter as long as it's 3 properties or less, okay? Now, if you want to identify more than 3 properties, you can do that, okay? But you're going to fall into this next rule. It's referred to as the 200% rule, all right? And what that states is you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the properties being sold. So what exactly does that mean? Well, what that means is if you identify more than 3 properties, okay, the combined purchase prices of all those properties that you've identified cannot exceed 200% or 2 times whatever the sales price was on the property that you sold, okay? Now, if you want to identify more than 3 and you also want to exceed the 200% rule, well, you can do that, all right, but you're going to fall into this next rule. It's referred to as the 95% rule. Now, you know, the 95% rule, it's very rare that anybody even enacts the 95% rule. You know, honestly, it doesn't make a lot of sense the way it's written. But remember, everybody, hey, this is the IRS, and I don't know, sometimes this stuff just doesn't make sense, okay? Let me read it to you guys, all right? Now, you can with the 95% rule, it states you can identify over 3 properties. You can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Now, I know that's not very clear. It's probably about as clear as mud. All right. Let me show you the examples, all right, especially with this last one. And hopefully when I show you the example of the last one for sure, how the numbers work, it'll click for you. All right. Now, here's the 3-property rule. Again, the 3-property rule states that you can identify three properties without regard to the fair market value. All right, so they can be any purchase price, any dollar amount. All right, so here's an example. we sell for $1 million. All right, sell a property for $1 million. And then we go out and we identify three properties, right? Since we've identified three, we're in the three property rule. Now, let's just say we're going to be buying each one of those for $1 million a piece. So we've identified how much? $3 million worth of property. Now, we could be buying each one of those properties for $10 million a piece. It doesn't matter, all right? For a total of $30 million in identification. It doesn't matter. As long as it's three properties or less, they can be any dollar amount. Now, what does matter? And I'll say it again. If you identify three properties, you better make sure you're going to be able to buy at least one of those properties. Now, what's the best way to lock up a property? Well, it's to put one of them under contract, right? So that's generally what we see is somebody will put one property under contract. That's one of the properties they identify. And then, I don't know, maybe they'll identify two other properties. Obviously, those aren't under contract, just as backups, all right? That's what they put in their form midnight of the 45th day. Because what can happen is if after midnight of the 45th day, let's just say the one they have under contract, if that whole contract falls apart, well, at least they have the opportunity to purchase those two other properties that they would have identified. Okay, so that's how the three property rule works. Hopefully everybody understands that. All right, if not, we can talk afterwards. Okay, now here's the 200% rule. Now this is when you identify more than three properties, but then you cannot exceed 200% or two times the combined fair market value of the property being sold. All right, so here's how it works. Again, we sell for $1 million. Now, this time we go out and we identify five properties, all right? Because we've identified five, what just happened? It took us out of the three property rule and it put us into the 200% rule, all right? So what does that mean? Well, what that means is the combined purchase prices of all five of those properties cannot exceed $2 million. Now, where am I getting the $2 million from? We sold for $1 million, right? So 200% of $1 million that we sold, or two times $1 million that we sold, is how much? $2 million, right? So that's a 200% rule. I think that one's pretty straightforward. Hopefully everybody gets that one. All right, now, here's the 95% rule. All right, again, this is where you identify more than three properties and you exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. All right, so here's how it works. Again, we sell for $1 million. Now, this time we go out and we identify 10 properties, all right? Since we identified 10, what happened? It took us out of the three property rule, right? Now, let's keep the math really simple. Let's say we're going to buy each one of those properties for $1 million a piece each, right? So we've identified how much in property? $10 million worth of property, all right? Because we've identified $10 million worth of property, we've exceeded our 200% rule, right? Because that was how much? $2 million, right? So this puts us into the 95% rule. So in our example, let's just say we only purchase 9 out of the 10 properties. Well, that's only 90% or $9 million, right? That's not 95%. If we do that, what happens is we blow our entire exchange and we have to pay all of the taxes. Okay, so the 95% rule, in reality, the way it works is it's really 100% of whatever you identify, you're going to have to buy. You know, and we're using really simple numbers. We're saying, hey, each property is going to be $1 million. You know what? Those purchase prices are going to be all over the map, right? It's going to be really hard to sit down and say, okay, let's see if I get this property. Wait. Only puts me at 93%. All right, maybe I need to make sure I purchase this other property. Oh gosh, that's only maybe 94%. The 95% rule, in reality of it, is 100%. All right, the IRS, they want to limit you in what you can identify. They don't want you identifying everything under the sun, because you know what? If you do that, if you identify everything under the sun, guess what? You're going to have to buy everything under the sun because of the crazy 95% rule. All right, hopefully everybody gets that. Again, it's very rare that we even see it's enacted, but I just want y'all to realize it does exist. All right, now how does the whole process work, or the closing process? Well, you know, we really start doing our thing once a contract gets signed on the property being sold. We refer to that as the relinquished property, because what happens is I need to get a copy of that contract, right? And I also need to find out who's going to be handling the closing, right? Because what happens is I'm going to reach out to that company, and I'm going to get what's referred to as the title commitment, the title search, right? And once we get the contract in and the title search, the commitment, we're going to turn around and we're going to prepare what we refer to as an exchange agreement, all right? And those are basically documents that set the exchange up, right? Those are going to be signed on the day the relinquished property sells, right? Because what happens in that transaction, we actually step into the shoes of the seller, right? And that's where we're able to take those proceeds, whoever's doing the closing, they're going to wire those proceeds over to us, and we're going to hold them on behalf of the seller, the exchanger, right? So that transaction happens, and then the clock's going to start ticking, right? Total of 180 days to purchase the replacement properties or property. The first 45 days is the identification period. So we're going to be sending out that identification form to the client, the exchanger. They're going to complete it, get it back to us by midnight of the 45th day. Now, once they get a contract in for their replacement property, we need to get a copy of that as well. We also need to find out who's going to be handling that closing, okay? Typically, it's going to be a different company, all right? Because we need to get their wiring instructions. We need a contact person, all right? If you think about it, we're holding all the proceeds from the sale, right? We need to get a contact person, a company name, that type of thing, right? Because we're going to prepare some other documents that they're going to sign at the purchase of the replacement property, all right? Because in that transaction, we actually step into the buyer's shoes, and that's where we're able to take the proceeds that we've been holding. We're going to wire those proceeds over to whoever's handling the closing to help them purchase that replacement property. All right, that's it. That's the closing process. It's a pretty simple process as far as the closings go. You know, just everything leading up to it is the complicated stuff, right? Trying to figure out what you're going to potentially buy by midnight of the 45th day. Figuring out, do you need to get a loan? Do you need to provide, talking to a lender, getting loan approval, all that sort of stuff, negotiating the contract. That's all the complicated stuff. When it comes to the closing process with a 1031 exchange, that's the simpler stuff, okay? So that's the process. All right, now, we're doing good on time as well. What do we charge? What are our fees? Well, everything that we've talked about today, and the most common type of exchange that we do is referred to as a delayed exchange. Now, a delayed exchange, again, is just everything we talked about today. It's actually where you sell first, so you're selling your relinquished property first, right? That sale takes place, the clock starts ticking, right? 180 days to close, 45 days to identify. You're purchasing last. You're purchasing your replacement property by day 180. Again, that's referred to as a delayed exchange. Probably, 90 to 95% of all the exchanges that we do are delayed exchanges, right? Now, what are our fees for that? Well, we charge $750 on the sale. All right. Now, we don't collect anything until it physically closes. Right. We're similar to like a realtor, where how they earn their commission. Well, they don't earn their commission until it physically closes. Well, neither do we. We don't earn that $750 until it physically closes. All right. I just walked you guys through the process. We like to get started once a contract gets signed. If we have the exchange agreement, all the documents are completed and they're waiting at the title company, escrow company, attorney's office for the closing to happen. If for some reason the contract falls apart, if it never gets to closing, we don't even charge any type of cancellation fees, right? We don't charge any kind of wiring fees, anything like that. It's a flat $750 the day it closes. Right. And when you purchase your replacement property, we charge $250. All right. That isn't collected until it physically closes as well. All right. So if you sell one property, you buy one property, our total fee is $1,000. All right. You could be selling a $100,000 property or a $100 million property. That's our standard fee. Okay. Now, there's a few other type of exchanges. We don't have time to go into them today. One's referred to as a reverse exchange, okay? That's actually where you actually buy first and sell last. It works just the opposite of a delayed. It's where you buy your replacement property first, and then you sell your relinquished property last, okay? They can be extremely complicated, much more complicated than a delayed exchange. We have to form a separate company. We actually purchase the replacement property before you sell your relinquished property, okay? Our fee for those start off at about $6,500. All right. Now, again, I don't have a lot of time to go into them today. I do have another class coming up next week. All right. It's an advanced class. It's going to be next Tuesday on the 18th. We're going to do that one from 11 to 12:15 Eastern time. So I'm going to go into the reverse exchange in greater detail. All right. I'm also going to go into this next exchange. It's called the construction improvement exchange, or an improvement exchange. It's also another term you may hear. It's referred to as a built to suit exchange. All right, those can work something like this. You sell your relinquished property, you find a replacement property, but you want to do improvements to it before you acquire it. All right, again, I don't have time to go into it today. Those start off at about $6,500 as well. They can be extremely complicated as well. Okay, we're working with contractors in the construction exchanges. We're having paying the contractors. We're forming a separate company. All right. Again, next week, join in. Have that advanced exchange. We're going to talk about improvement exchanges, reverse exchanges, other types of exchanges. That's it. All right, we're done. We're doing great on time today. If y'all have any questions, feel free to type in any questions. Again, there's a box that says questions if you want to type them in. While we're waiting, I'll mention this again. So again, everything that we talked about today was recorded. All right, you're going to receive a link to today's recording. You also, as I mentioned in the very beginning, a lot of what we talked about today, I have in just single page like PDFs. Like when I talked about vacation homes, I have that as a PDF. Some of the other topics I have is PDFs. One that's just general information about 1031. If you want me to email those over to you, please just let me know. All right, my email's on the screen. I'd be glad to send it over to you, especially if you're a realtor and you work with potential 1031 exchange clients. You know, most realtors tell me, gosh, I'd really love to have something to be able to send out to my clients. This would be perfect for you. All right. Also, I'll mention this again, that class that I have next week. All right. It's going to be on the 18th. It's next Tuesday. It's going to be an advanced class. We're going to go into more topics. We're going to talk about the different various types of exchanges. We're going to talk more about the numbers. I'm going to walk you through how to figure out what the taxes are. We're going to talk more about partial exchanges. We're going to talk about entities, LLCs, partnerships, what issues they face, tenants in common. All right. If you can join in, great. It's going to be from 11 to 12:15 Eastern. I need an extra 15 minutes to fit everything in. But the registration information, if you have got the registration information for today's class, it should be on the same the posting. If not, just let me know. I can send it over to you. And also coming up on the 25th, Tuesday the 25th, the following week, I am actually offering a 2-hour continuing ed class for any realtors in the state of Florida. Okay, you will receive 2 hours of continuing education by attending the class. You know, we talk about the basics, we talk about the advances, even additional information that I don't talk about in either class. If you're not a realtor, you feel free to join in. You just obviously wouldn't get any credit for it because you're not a realtor, but you get some more information than what we typically have in either classes. All right, that class is going to be on the 25th. It's going to be from 11 a.m. to 1 p.m. Eastern time. All right, if you want to join in on that, feel free. The registration information should have been sent with the class the information for this class. If not, let me know and I can send it to you. All right, so let's see. We do have some questions coming in. That's good. All right, let's see here. What is the amount for 1031 exchange? Sales price or sales price minus commission, other expenses? Amount for the 1031 exchange. I assume you're asking, okay, so I assume you're asking the replacement property. All right, so you're required to use the entire net proceeds, all right, and you have to use that entire net and buy replacement property equal to or greater than whatever the sales price was on the property that you sold. Now, your question, you know, about commissions, you can deduct some of the commissions as allowable expense. It may be a little bit less than the actual sales price, but you know, typically you don't know that until you get to closing, until they work about the numbers. All right, commissions, title insurance is another expense, some of the closing fees, non-reoccurring fees. I talk about that in the advanced class a little bit more, but that's generally what we tell people is you have to buy something equal to or greater than whatever the sales price was on the relinquished property. All right, hopefully that answers your question, Ramondo. If not, we can talk offline and I can go into more detail with you. Okay, you still have another question. If selling a house and buying 2 condominiums, how many properties do you have to identify for the 1031 exchange? Three per condominium. You can identify as many properties as you want. All right, if you want to buy 2 condos, then if you have them, if you have those 2 condos, if you have addresses for them, by midnight of the 45th day, that's what you need to put on the form. All right. If it's after midnight of the 45th day, even though your intent is to buy 2 condos, if you haven't listed them on the form, then you're not going to have the opportunity to purchase anything other than what's on the form, the 45-day identification period. There is no options after that. Hopefully that makes sense to you as well. All right. Another question: can you carry the 1031 exchange onto another year, 45 days from today, and 180 after? Can you carry the 1031 exchange onto another year, 45 days from today, and 180 after? Not quite understanding what you're asking. You're saying carry into another year. You can carry your exchange over to the following year. Like, let's just say you closed on December 31st. Okay, you still have the total of 180 days and the 45 days. It would carry into the next year if that's your question. Hopefully that answers it. You can carry into the next year. It's actually 180 days, or the date you're required to file your tax return with extensions. The reason I didn't mention the tax returns, because you don't really need to worry about that until we get into like mid-October. Because if you have a closing that occurs after, I think it's like October 17th or 18th, and your tax returns are due on April 15th, it could actually be less than 180 days away. Not to try to get too complicated. Now, if you file an extension where you don't have to file your tax return on April 15th, you can get the full 180. Hopefully I'm not confusing anybody, but that's why I didn't mention it, because again, you don't need to worry about it until later in the year. If the later you close in the year, then it may affect the 180 days. All right. If I confuse anybody, I'm sorry, but just trying to answer his question. Just think 180 days, and the first 45 is the identification period. All right. That doesn't make sense, just give me a call. We can talk about it. All right. Okay. It doesn't look like there's any other questions coming in. If you think of something after we hang up, again, shoot me an email, give me a call. If you have any clients that have 1031 exchange needs, I'd be glad to talk to them as well. I talk to people about 1031 exchange all day long. All right. You individually, if you're an investor yourself, you have your own personal investments, you want to talk, give me a call. All right. I talk to people, they don't even have their property listed yet. All right. They just want to get some ideas of what their potential 1031, how it would affect them, what if it's a benefit or not. All right. Again, at any point, just give me a call, shoot me an email, and I'll be glad to talk to you or any of your clients that may have potential 1031 exchange questions, looking to do it. All right. We're going to go ahead and wrap it up for today. All right. I appreciate everybody attending today. We did great on time. And again, if you want to attend those other classes that are coming up next Tuesday and the following Tuesday, please just register for them. If for some reason you didn't get the registration information, shoot me an email. I'll send it over to you. All right. And hopefully everybody stays safe. Please stay healthy. And hopefully we'll talk soon. I appreciate everybody attending today. Have a good rest of your week. Thank you. Bye-bye.